Imagine waking up tomorrow and discovering that every dollar you've ever earned, every rupee you've ever saved, every number glowing in your bank account, is nothing more than a promise created with a keystroke, backed by confidence, and held together by a system nobody ever voted for. A system so powerful that it can create money out of absolutely nothing, yet fragile enough that one wrong move can collapse economies, spark revolutions, and rewrite history. We trust this system because we're told it's safe. We believe in it because it has existed longer than us. But what if I told you? Most of the money in the world doesn't come from governments. It doesn't come from productivity. It doesn't come from gold. It comes from a shadow mechanism, hidden in plain sight, a mechanism that expands and contracts the supply of money, affects inflation, controls debt, and shapes the destiny of nations. All without being understood by the very people whose lives depend on it. Tonight, you and I will walk through that system step by step, not just how it works, but why it was built, who controls it, and why every financial crisis of the last century traces back to this single money-making machine. Welcome to a world where dollars are illusions, debt is oxygen, and the real power lies not in governments, but in the architecture of credit. This is the story inside the shadow system where money is manufactured from thin air. Setting the stage, history, background, teasing twists to understand today's system, we must return to the beginning when money was not a digital illusion or a government declaration, but a physical object born from scarcity. Long before modern banking, money meant gold, heavy, rare, hard to produce, a metal that kings could not print and governments could not conjure. Gold behaved like a cage. It prevented rulers from spending more than they possessed, and prevented countries from creating money without restraint. That cage was both a blessing and a curse. A blessing because it kept inflation low. A curse because it limited growth and made wars expensive. Then came a twist in the story, one that set humanity on a path toward invisible money. Because eventually bankers discovered something extraordinary. People rarely withdraw all their gold at once. And if people rarely withdraw all their gold at once, the gold doesn't actually need to be there. That simple observation, the recognition of human behavior, became the seed of the modern financial system. If a bank had 1,000 gold coins and depositors kept only 100 coins at home, the bank could lend out 900 coins even though it didn't actually have them. This was the birth of fractional reserve banking, a system where banks print credit instead of governments printing currency. But this was only the origin story. The rise of the shadow system would require global wars, failed governments, collapsing empires, and one decision in 1971 that would change money forever. Let's move chronologically. Origins. The first financial illusion. The first illusion. Lending gold that didn't exist as banks lent gold they didn't have. Something unthinkable happened. Money supply began expanding without any physical increase in gold. This was the first moment in human history where real money was created out of thin air, and it worked. Economies grew. Trade expanded. Governments loved it. But there was a hidden cost. The system depended on confidence. If people believed the gold was there, everything functioned smoothly. If they doubted it, the illusion shattered. Throughout the 17th and 18th centuries, bank runs exposed the fragility of this system. When trust cracked, people rushed to withdraw their gold. Banks failed, merchants collapsed, governments panicked. Yet every collapse taught bankers new lessons. People respond to incentives. Fear spreads faster than money. Confidence is more valuable than gold. By the mid-1800s, the world realized something profound. Money is not metal. Money is trust, and trust can be engineered. The quiet revolution that no one noticed, the gold standard, emerges in the late 1800s. World powers agreed to something radical. A global monetary system anchored not by trade, not by power, but by gold-backed currencies. Governments promised to exchange paper money for gold at a fixed rate. People trusted these promises. Trade flourished. But there was a flaw, one that would later shatter the world. A gold-backed system cannot print money during crisis. And crisis was coming. World War I, the system cracks when WWI exploded in 1914. Governments faced a choice: stick to the gold standard or print money to fund war. They chose printing. Gold was abandoned. Currencies inflated, debt surged. When the war ended, politicians tried to return to normal by reattaching currencies to gold. But it was too late. Prices, wages, and debt no longer matched gold's rigid limits. This mismatch planted the seeds for the next disaster. The Great Depression, a system out of sync in the 1930s. Deflation crushed economies, banks collapsed, factories shut down. Countries again faced two choices: hold on to gold and suffer, or break free and print money nation by nation. The gold standard collapsed. The world learned something it never forgot. Printing money saves governments but destroys the value of money. Breaking point. 1971. The night money lost its anchor after World War II. The U.S. promised global stability through the Bretton Woods system. America guaranteed that every dollar could be converted to gold at $35 per ounce. But as Europe rebuilt and the Vietnam War drained U.S. finances, something predictable happened. Other countries began redeeming their dollars for gold. Gold reserves fell. Confidence crashed. The system trembled. Then came the night that changed everything. August 15, 1971, Nixon ends the gold standard on live television. President Richard Nixon made a decision that ended 6,000 years of monetary history. The United States will no longer convert dollars to gold. In that moment, money became pure belief. No backing, no anchor, no limits. Governments were now free to print as much money as they wanted. Banks were free to create as much credit as they could lend. This was the birth of the modern shadow system. Fallout. The world learns to live with invisible money. Consequence number 1, explosive debt growth. Once money was in tea tied to gold. Governments found the perfect drug: debt. 1971 global debt was around $1.5 trillion. Today it exceeds $350 trillion. Not because productivity grew that fast, but because our system requires debt to survive. In this new world, money equals debt, savings equals someone else's liability, economic growth equals more borrowing. Inflation built into the architecture. We had entered the era of perpetual credit expansion. Consequence number 2, inflation becomes a feature, not a bug. Governments realized inflation quietly steals from citizens without raising taxes. Banks realize lending makes more money than saving. Corporations realize debt boosts profits faster than productivity. The world adapted, but this adaptation created monsters. 1987 stock market crash, 1997 Asian financial crisis, 2000 dot-com bubble, 2008 global financial crisis, 2020 pandemic, stimulus shock, and the inflation wave of 2021 to 2023. Each crisis was bigger than the last. Each bailout required more money printing. Each rescue inflated the system further. Failed fixes. Why every solution makes the problem worse. Governments tried tightening regulations. Banks tried limiting leverage. Central banks tried balancing growth with responsibility. None of it worked. Here's why. Reason number 1, the system requires continuous expansion if money is created through loans. Then the moment loans shrink, the money supply collapses. This is why every recession is met with lower interest rates, more borrowing, more stimulus, more quantitative easing. The system cannot shrink without breaking. It must constantly expand or die. Reason number 2, central banks fear deflation. More than anything, deflation destroys tax revenue, corporate profits, wages, stock markets, housing markets, government budgets. So central banks print money to avoid deflation at any cost. Reason number 3, politicians love free money. No one wants to raise taxes. Everyone wants to spend more. The solution? Print, issue debt, inflate it away later. The result? Debt grows. Money expands. The shadow system deepens. Parallels. The new shadow system today. Money is not printed by governments. It is created inside a network of institutions. Commercial banks, central banks, investment banks, hedge funds, money market funds, shadow lenders. Derivative markets. This network worth quadrillions of dollars creates money-like instruments. Overnight loans, repo markets, leveraged credit, synthetic debt derivatives that behave like currency. These instruments are not controlled by the public, not backed by gold, not regulated like traditional money, yet they determine interest rates, mortgages, stock prices, currency stability, global liquidity, the fate of entire nations. This is the modern shadow system, so vast that even governments depend on it. Shocking data points: 90% of global money supply is digital credit created by banks. Only 3% of US dollars exist as physical cash. The true global derivatives market is estimated above $1 quadrillion. Over 70% of global financial transactions pass through shadow mechanisms. Governments cannot shut it down without collapsing their own economies. This system was not designed. It evolved like a creature adapting to survive. But evolution comes with patterns, and these patterns reveal a dangerous truth. Every financial crisis follows the same script. Credit expands, confidence cracks, liquidity freezes, and central banks print more to save the system. The shadow system is both our lifeline and our greatest risk. 3 takeaways. Takeaway 1: money is no longer a thing, it's an idea. Modern money is confidence converted into numbers. It is created through credit, backed by trust, and supported by belief. Takeaway 2: debt is the engine of the world. Without debt, economies would halt, markets would crash, governments would default, banks would collapse. Debt is not a byproduct, is the foundation. Takeaway 3: crises aren't accidents, they're features. Every crisis resets the system by allowing more printing, more debt, more expansion. The system survives by growing into every crisis it creates. Final warning: what happens next if money can be created from nothing? If debt must expand forever? If the shadow system grows faster than the real economy? Then there's only one logical outcome. Eventually, the system reaches a point where confidence is the only thing holding it together. And when confidence weakens, when trust cracks, when doubt becomes stronger than belief, the system doesn't fade, breaks, not gradually, but suddenly. And the next major financial reset, whenever it comes, will redefine how the world understands money itself. If you want to understand the hidden architecture behind inflation, debt, banking, and the global financial machine, hit like, subscribe, and share this video with someone who still believes money is simple. Because the deeper we look, the more we realize nothing about money is what it seems. This is Finance TED Official, revealing what happens behind the curtain so you can prepare for the world in front of it.